everyone will need, right? Do I expect my cousin, you know, my cousin husband next door at the age of 43, you know, suddenly need long-term care? You know, one day he was healthy, the next day he was in a coma, right? Never, never, you know. So it is important that we plan, you know, for long-term care while we are still healthy, right? So there are some factors that can increase the risk of needing long-term care services. For one, I list here 5 factors: age, gender, marital status, lifestyle, and health and family, you know, history, right? Age, it is given that as you get older, the chance of you getting into an accident or falling will increase. The same can be said for arthritis, cardiovascular, or heart condition, right? You know, my parents, you know, they are in the 80s, they both in their 80s. And I told them, Mom, Dad, you can do anything you want. You can drive, you can travel, but there's one thing you cannot do. You cannot fall, right? Also, cognitive impairment, such as Alzheimer and other, you know, nervous disorder, also increase with age. Okay. Second, risk factor that need long-term that can increase the need for long-term care is your gender, right? Women are at the higher risk than men, primarily because they just live longer, right? Living longer mean what? Mean we will not be living as well into our later years. So at some point, we will need long-term care services. If you live into 90 or 95, you're going to need some sort of long-term care services. How about marital status? If you're single, you likely will need long-term care because you will not have anyone to take care of you. Who are you going to depend? Your brother and sister, your relative, they have their own life. They have their own family to take care of. Okay, so you will definitely need long-term care services. Your lifestyle, poor diet, lack of physical exercise or activity can also contribute to many later years health issues. So right now we have a lot of kids not doing exercise. You know, I fear for them in the future for their health, right? How about health and family history can also play an important role, right? Family history increase your chances of certain health issues like Alzheimer, cancer, heart condition. So keep in mind, your age raises the chance more than your family history as far as getting, you know, increased chances of those conditions, right? For example, people in the 70s have a 5% chance of being diagnosed of Alzheimer if that's in your family history, more than twice than people in the 60s, okay? So those are 5 factors that can increase the risk of needing long-term care. So what is long-term care when it comes to comparison to other risks, like house fire, right? Like automobile accident. You know, we are living in a house, apartment, condo, right? 5 out of 1,000 will have a house fire. Average loss about $3,400, right? What about automobile accident? All of us drive, right? One way or the other. 70 out of 1,000 will have an auto accident. Average loss is about $3,000. So how many out of 1,000 people do you think will need long-term care? Type in the chat box. You can, you know, type in the chat box and let me know what you think the number is or the percentage. Right. So yes, look at this number right here. 700 out of 1,000 who reach age 65 will require long-term care. The cost, look at the cost, $87,000 per year. That's vary from state to state, okay? So wow, 70% of people who reach 65 will require long-term care. But as you can see, the cost is very high, right? But despite knowing all that, 70% of the people will need, you know, long-term care. Very few has any type of long-term care protection. You know, as a, you know, joining the financial industry, and I like to educate, you know, our community about the importance of long-term care. You know, we should make sure that everyone understand that long-term care should be part of the family protection planning. Okay, so when they plan for their family protection, long-term care should be part of that. So one of the most important thing about long-term care is the impact that long-term care have on an individual, as well as the family, right? Does anyone here experience in your family or circle of friends who need long-term care? You know, people usually don't buy any long-term care, okay, insurance until what? They either have a friend or family who needs it, somebody who can't take care of themselves and who need help, right? Going to the bathroom, eating, dressing, getting around. You know, you realize what kind of burden it will put on a family. You know, like our family, you know, we don't even see the importance of long-term care planning, right? But after seeing my cousin husband next door at age 43, having a stroke, well, remember he was healthy one day, the next day he was in a coma. And he need long-term care services. Until now, he's living in a nursing home, right? And both my wife and I, after that experience, you know, we want to make sure that we have long-term care insurance to protect our family. So when you look at long-term care, you know, earlier we compared to fire, to automotive accident. But if you compare to a death in a family, in death in a family, usually poor family together. You know, I've been to many funerals, you know, in my lifetime. You know, everyone come together, you know, from all over the state, all over the country, you know, flying to, you know, to get together and pay the respect. But with the event like long-term care, right, it can pull a family apart, right? The impact of long-term care on a caregiver can have a long-term effect on the physical, emotional, and financial. You know, I've seen, you know, what my cousin family went through and the financial toll they had on that family, where they have to give up their home and everything they have owned. They worked so hard for it, right? In an instant, they lost everything. That tear their family apart for so many years. You know, to this day, he's still living in a nursing home, like I said before. That was tough to witness for someone I know, because, you know, they are next door to me and they are my cousin. So the question here is, do you have a plan for long-term care in case you need it and to protect your family, right? And for some family I listed here that they don't have a long-term care plan, protection, they have to use their retirement money to pay for the long-term care services. I definitely want to use my retirement money for something else other than paying for my long-term care service. How about children? You want them to adjust their life to take care of you as a parent? You know, my wife and I, we like through, you know, in the introduction, I have 3 kids, right? Who will care for us in the event, you know, we will need long-term care. But is it right for us to ask them to suspend their life to care for us? You know, especially if we don't know how long. But if you have a plan in place, the interruption to the family, daily life will be very minimum, right? So when family member get together and try to come up with, you know, an agreement to care for you, you know, to care for you, there are going to be many disagreements. You know, some of those disagreements have emotional strain on the family, and it could also tear the family apart. That's something that I definitely do not want for my family. Okay, so make sure you plan for your long-term care early. All right, so that's very important. So we just cover the qualification of long-term care, who will need it, the impact of long-term care. Well, let's look at one of the most important things other than the impact of long-term care on an individual or family. How about the cost of long-term care in your state? Do any one of us know what it costs in the state of Texas for long-term care? Average yearly? Each state cost varies, right? I'm gonna list 4 states: state of Texas, California, New York, and the state of Washington, right? The list here is long-term care costs per year in 2021. You know, from this list, I'm staying in the state of Texas. Thank God, look at the number. $27,000 to $67,000 average yearly, compared to California, New York, and Washington. They range from 35,000 to 162. That's currently, that's how much it costs average. But what if I fast forward 20 years from now? Okay, 20 years from now. Let's take a look real quick, okay? If you look at the state of Texas, you go from 27,000 to, average to 67,000 to 40,000 to 141,000. Look at the state of California, right? 36,117 to 64,246. The state of New York, 35,162 to 63,322,000. And how about the state of Washington? 40,119 to 74,237,000. Okay, wow, that is double. 20 years from now, your long-term care costs from each of those states that I just showed you will be double. This is why it's important for us to prepare early. Okay, we don't want to wait until 20 years from now and find out that long-term care, is going to double the cost. But if you can go to that website that I listed below, you can even fast forward to 30 years from now and see how much it will cost. I can guarantee that it likely will be triple or double or triple. Okay, so that's the cost of long-term care. So let's look at some of the, well, before we do that, anyone on the Zoom or have family living in the state of Washington? Give me a hands up. Okay, right. The state of Washington just rolled out the Washington Long-Term Care Trust Act, now renamed to Washington Care Fund. This sounded like a lot friendlier, than the Washington Long-Term Care Trust Act, right? So who will fund the program and how does it work? How can you opt out of this program, right? I listed here a few important features, right? To opt out, you must purchase a long-term care insurance before November 1st, 2021, right? How is it fund? How is this program fund? It is funded by 0.58% payroll tax on all wages. And you have to pay at least 10 years, right, to be fully vested. But look at the lifetime maximum benefit, 36,500. Right? We just went through the cost for state of Washington. You probably can use that 36,000 probably in 6 months, and then there's no more money, right? So why do we think the state of Washington actually doing this? Okay, if you take a good look at the long-term care, like I showed you earlier, every year the costs just keep rising. We just went through the cost for 4 states, right? So who is going to pay for them? The government? Can anyone depend on Medicare, Medicaid in the future? Not really. To make sure that most people have a type of protection, some type of protection. They come up with the Long-Term Care Act for the state of Washington, right? They are the first, trust me on that. Other states will follow. Okay, so if you need more information about it, go to the website I listed below here. If not, go to Google, do a search for State of Washington Long-Term Care Act, okay? And it will give you additional information. But we're lucky right now, we still live in the great state of Texas. This act has not come to the state of Texas at this time. Okay, so I'm gonna move on to the next page. Let's talk about some of the misconception, right? We just learned about the cost of long-term care. What are some of the misconceptions of long-term care solution funded, long-term care funded, right? So when you talk about long-term care solution to other people, they go, oh yeah, I have health insurance. Some people will tell you I have Social Security, right? Some people will tell you I have long-term care disability, Medicare, I have Medicare, I have Medicaid. I have my children, they will take care of me. And I can pay out of my own pocket. I have a lot of money in the bank, right? So when you take a look at health insurance and Social Security or Medigap, well, guess what? They don't cover long-term care expense. How about long-term care disability? Well, they only cover your lost income. you know, but it doesn't pay for your long-term care need. But when you retire or when you get laid off, you know, those long-term care disability will also disappear. Okay, what if somebody told you they have Medicare? Well, Medicare only pay a portion of long-term care. It covers up to about 100 days. After that, after the first 20 days, you already start incurring a copay, right? And after 100 days, guess what? All the cost is yours, okay? And then you go, what if I have Medicaid? Medicaid, okay, that's fine. It only cover if an individual with asset of $2,000 or less. I believe most of us on this Zoom would likely not qualify for that, okay? And the care may be only limited to a nursing home. So you can't really pick and choose the facility that you, or even home care, right? So how about adult children? Are they willing or able to take on the burden of professionally, financially, or emotionally? You know, as a parent, do you really want to put that type, you know, of burden on your children? How about out of pocket? Using your saving or selling your asset to fund long-term care service? Why do you want to do that? You know, you can use your saving and asset, right, to fund your retirement, travel the world, do anything you want. You can use the insurance from long-term care policy, right, to fund your long-term care service, right? So use the insurance money instead of your own money to fund that long-term care when you need it. Okay, so that's very important. Prepare early, right? So now we know the impact, the cost of long-term care, you know, the misconception of long-term care, you know, funded. Let's look at, you know, look at this, how we can plan ahead and strategize, you know, for our long-term care needs. There are 4 different strategies are going to be listed here. Number 1, the traditional long-term care, right? Number 2, the life insurance plus long-term care rider. The third strategy will be asset-linked long-term care. And the 4th strategy will be annuity-based long-term care. You know, traditional long-term care is just like your home insurance and your car insurance, right? You use it or lose it. You just pay for the long-term care. That's all you're paying. The premium are not guaranteed, right? Currently reimbursement only, you pay first and then I'll reimburse you, okay? The second strategy is life insurance plus a long-term care rider. You know, it consists of what? Death benefit, cash value, and long-term care benefit, right? It has a guaranteed premium. It has cash indemnity and reimbursement. So we will come back to this 2 term, cash indemnity and reimbursement, you know, in the later slide. So how about asset link and long-term care? It consists of death benefit, long-term care benefit, like care, you know, like we have a lot of company that we're working with have some great asset link long-term care. No use it or lose it, premium or guarantee, right? You can choose the benefit period and inflation protection. It has cash, indemnity, and reimbursement, right? And then look at the 4th strategy will be annuity-based long-term care. You know, it's guaranteed the account value. Long-term care benefit can be double or triple. You know, no use it or lose it. Single premium required, however, you have to put a single premium down. Premium are guaranteed, right? And currently reimbursement only. This is for those people that have bad health, like me, right? Because I'm not qualified for asset-linked long-term care. You know, I have annuity-based long-term care for myself, right? So if you qualify and you confine to a long-term care facility for 180 days out of the last 250 days, the lifetime income for your annuity-based long-term care will be double or triple, right? Depending on the policy. So to strategize or to customize, you know, this 4 plan, you can, you know, you can pretty much mix and match them, right? Currently, I have insurance with long-term care rider plus life insurance. That's when I was young. But when I, you know, become, you know, getting older and I realized that I need more protection for my long-term care, I try to get some asset link, not qualify. So what do? I'm going to go to annuity base. So I can mix and match them. So there's no cookie cutter. So you can, pretty much use any of this strategy to support your need, right? So that is how we strategize and can help you strategize for planning your long-term care. So remember the two terminology that I mentioned earlier about reimbursement and cash indemnity. Well, reimbursement is like, it's like everybody know that, right? You pay first and the company will pay you later. Every month you have to submit a receipt, right? So the company will send you a check for only what's covered. So anything that's not covered, it'll be out of your pocket, right? But for cash indemnity, it's a little bit different. Once you qualify for 2 out of the 6, ADLS, remember walking, transferring, eating, bathing and clothing. If you qualify 2 out of the 6, then the company will mail you a check every month. You don't have to submit any receipt. And there's no restriction, that how you can use, how you're going to use the money. You can use the money to travel. You can use the money to, say, put down payment on a house for your grandkid. You can use the money to put back in the bank, right? You can do anything with that money. They really don't care, okay? So that is why I really like how cash indemnity actually work, right? So that's 2 terms, reimbursement or cash indemnity, right? So now you know who need long-term care, the impact, the cost, some of the misconception on how it is funded, and how to strategize for long-term care. Well, you can customize your long-term care plan, right? So there are 4 categories here that you can customize. But one of the most important things that I want to show you is the inflation protection for your long-term care policy, right? There's some popular option, 3% simple, 3% compound, and 5% compound, right? For specific detail, how this inflation protection work, you can talk to the person that invite you, to that seminar. But there are 3 other categories that you can customize your long-term care plan as well, policy, like elimination period. Before long-term care benefit are paid, you can customize to 20, 30, 60 days, 90 or 180 days. How about the benefit period? 2 years, 3 years, 4 years, 5 years, 6 years, or 7 years. And lifetime, right? So these are some of the customization that you can do for your long-term care plan, right? Well, here come the fun part. You had a plan, you customize your plan, and now it comes to this part, the preference of care. You decide where and how do you want to receive the care. Home care, assisted living, nursing home. So who do you want to provide your care, right? So that should be fun. This is where the fun part began, okay? So most people, when they think about long-term care, insurance, they think that you can only be used, in a facility, right? You can only use the long-term care insurance in a facility. Well, that's not really true. When you look at the data that collected in 2019 by the American Association for Long-Term Care Insurance, most insurance claims are for home health care. You can get long-term care services from the comfort of your home without even leaving your home, right? So when you look at nursing home, for example, insurance claim is about 23%, right? When you look at the assisted living, it's about 25%. Look at home healthcare, 52%. And that's data from 2019. I'm almost positive from 2020, it will be higher because of the pandemic, right? So it is very important that you understand that when you have a long-term care policy, you can use it for home health care instead of, use it on a facility like nursing home or assisted living facility. So with that, Here are some of the popular long-term care carrier, including our parent company, Transamerica. Even though we are part of Transamerica, we are an independent agent, which means we can work with so many wonderful company or carrier to come up with a best long-term plan for our client. We work with Pacific Life, Lincoln Mutual, Omaha, Nationwide, and Transamerica, and One America. Right here are just some of the popular company. I just want to list it. So when you look at family financial planning, where is long-term care in that family financial planning? There are 6 areas every family needs to manage, right? So I'm going to start with investment, tax saving, college funding, retirement, protection, and estate planning. So where do you think long-term care fall under which category? When you look at estate planning, you have probate and tax. And investment, you have return and risk. When you look at tax saving, you have tax now, tax later, and tax free, right? When you look at college funding, you have saving and financial aid. How about retirement, growth, protection, and longevity? So long-term care fall under the category of protection. So you need to protect your family by not placing the burden of care for you on your children or your spouse. So within the family of financial planning, protection comes first, right? Protection is the most important thing, right? And also, our company, we do a lot of seminar, for our community, and we cover, this 6 area of planning, from estate planning all the way to protection. So you're welcome. Talk to the people that invite you if you want to attend any of this, topic. Okay. So with that, I would like to introduce a very wonderful, speaker. Her name is Jenny Lee, who has 15 years or more experience in helping so many families, with the financial planning, right? She is an executive vice chairwoman in our firm. She will share some of the case study on how to plan, for your long-term care. Jenny, the stage is yours.
Thank you, Dan. Thank you for sharing this very professional and comprehensive introduction about long-term care. I'm sure all of us online, whether you are first time or you've been with us a couple of times, a few times, you sure learned a lot tonight, right? Let's thank Dan for his wonderful delivery of information on long-term care. Thank you so much, Dan.
Good, Jenny.
Yeah, let me share screen, and I'd like to share with you some examples. Sometimes when we see the examples and we we understand better and we click, right? And we can relate better with ourselves. Okay, so I will share 4 cases with you. Remember, Dan said 4 types of long-term care policies, right? Long-term care solutions. The standalone, like auto insurance, right? You pay, and if you qualify, and then they pay you the benefit, right? And if you don't qualify, and then you won't get anything back. That's the standalone one. Yeah, and standalone one, and the premium could go up, and actually it went up significantly. I know for some of the policies, right? And also you have to pay always until you qualify. Okay, I see a question coming up, right? I think it probably refers to that type of policy. We can clarify with Brandon at the end, right? And then the other policy is annuity-based long-term care. Okay, that's the 4th type that Dan was referring to. And that one, let me tell you, if you cannot qualify the insurance-based, right? And then you go to the annuity-based, okay? And the insurance-based need underwriting. Okay, so it requires you to qualify for the policy. If you can, you want to go this route first, all right? And if you cannot, then the annuity one requires no physical checkup or interview or any medical records, right? And you can have some multiplier on your asset if you need long-term care, okay? So my case studies, the 4 case studies tonight, is going to be the most popular 2 types of policy, the asset-linked one and the life insurance and long-term care rider combo one, okay? Let's start from the first one. Remember this one, the asset-linked long-term care, which focus on providing a small death benefit and the maximum long-term care benefits. I want to thank one of our senior advisors in Texas to provide this real case to us, right? So we can get some insight about this type of solution. This is a 56-year-old female. She's quite active and quite healthy, right? She dances and she has a very upbeat spirit, right? IT professional, and she plans to work another 10 years. But the family history, is not in her favor, right? That's probably why she came to our advisor and sat down and looking for solutions. Okay, and she's married with 1 son. All right, her needs she has expressed, right? She does not care about the death benefit. Okay, the son is doing well, husband is doing well, and they have accumulated a good retirement plan. And she wants to have a long-term care solution which can maximize long-term care should she need that. And also given right now the current market situation, right? And she wants to have guarantees. She does not want to have the benefit linked to the up and down of the market or the current interest environment, right? So she wants to have guarantee and decent return on the benefit for her money. Yeah, so our advisor provide her with Nationwide Care Matters. Yeah, this is an asset-linked benefit. So he plans to pay for 5 years. And like Dan said, she can choose the benefit duration, right? Whether to cover 2 years or 3 years or 7 years. Yeah, and she chose 6 years. All right, most people, most claims, most people claim the benefits 3 to 4 in the nursing home. All right, but like Dan said, most long-term care claims started from home, right? So if you have a long-term care policy that can actually pay you long-term care benefits while you are receiving care from your home, then the duration of you claiming long-term care could be longer, right? It's not going to be 3-4 years. It's going to be longer than that. Okay, so this lady, with that in mind, right, she got educated and then she picked this 6 year, and with a 3% simple inflation, she figures out in the future the long-term care cost is going to be higher, just like Dan showed us, right? The inflation, the growth rate on the long-term care cost is, almost double the regular inflation. Yeah, so she picked 3%. With a death benefit, about 66,000, a little more than the total premium, 55,000 she puts in, right? So if nothing happens, everything's good, no long-term care claim, and she's going to get the money back plus a little bit interest through a death benefit paid to the family. Guess what happened? A year later, this lady, unfortunately, right, she had an incident, all right, and then she claimed after 1 year, the policy is in force, all right. She has paid into $11,303, right? And once she started claim, she does not need to pay any more premium. Okay, so that it's just that, you know, first year, right? Yeah, premium. Okay, no need to pay subsequent premium as long as she's on claim. All right, and then she's getting to 2778 the first 12 months. Yeah, since the inflation rider she picked, then the next 12 months, then she's going to get get more, right? And then the third year, she's going to get more. Yeah, so overall, in 5 years, she's going to get 221,000. Okay, from year 2 to to year 6. All right, every year she just need to recertify by her doctor that she still qualifies. All right, then she gets the check from Nationwide, and Nationwide does not need any receipt. She can receive the care from home or facility or hospital, anywhere. Even she goes on, you know, on a trip, right? And she can get that check as well, and she can spend the check however she wanted, right? She can have the relatives coming to take care of her. Okay, neighbors coming to take care of her, right? And also it's tax free. Okay, to this lady. Yeah, so that's the asset linked no care matters first example. The second example, also a lady. Well, you can see how the ladies are more worried, right, about their care. Usually in the family, the ladies take care of the men, right? Most family, the ladies younger than the husband, and on average, ladies living longer than the husband, you know, and they're mostly the caregivers, you know, but once, you know, they are all by themselves, who's taking care of her. Yeah, so that, I guess that's maybe the reason why ladies, you know, is more interested in seeking solutions on long-term care. Yeah, and this lady, 60 years old, also from Texas. Yeah, she's a researcher and plan to retire 5 years later. Very healthy, and also has a family history of Alzheimer, right? And married and with adult children. Yeah, and her needs, right? Her desire is the same. Yeah, she does not care about cash value. She's not expecting to take cash from the policy or expect a huge death benefit, right? If she does not use the long-term care, she just don't want to be a burden, right? And she wants to have the most asset used on herself in case she needs long-term care. All right. She also want to have guarantees. At the age of 60, she does not want to take any chances, right? Yeah. So the solution, the Nationwide Care Matter also, you know, is the best solution for her, right? And with us, we work with a lot of carriers, and we run multiple solution options for our clients, and they can choose, right? And this lady, she happens to have, you know, those idle money. You probably know people like that. They save their money in the bank, like, you know, 100K, 200K, and even some people have $500,000 saved in the bank, and they don't want to invest in the market, right? And they don't earn interest nowadays from the bank. Yeah, so it's just that she's transferring part of the cash holdings from the bank account to this Care Matter account. All right, and then if she would not use it, right, she get this the premium back with a little interest in the terms of death benefit. All right, back. Of course, it's paid to the beneficiary. That's in the case that she does not need long-term care. Okay, what if she needs long-term care? Okay, let's see, Yeah, she's a single pay. Now, instead of 5 pay, she chooses single pay because she has that money sitting there earning no interest, right? Okay, so here's the projection of the long-term care benefit. Okay, at the day one is close to 200K, right? And because she picked the 3% simple, so the benefit pool increase if she claims later, right? And just the one single lump sum premium, all right? And then the long-term care benefits is guaranteed, yeah. And she choose a 6-year period. So it's going to be paid out to her monthly and per this table, right? If she qualifies, lose 2 out of the 6 ADLs or become cognitive impaired, and then she will, at age 79, she will be paid 39.25 the first 12 months, right? And the total 6 years, she's going to get 296,000, all right, purely for, for her to spare for long-term care or anything, right? Yeah, and tax-free, all right, and everything's guaranteed, huh? Everything's guaranteed. That's the uniqueness of this asset-linked programs. Yeah, not only Nationwide, we got some other choices like Lincoln, MoneyGuard, and Securin, right? And similar companies, huh? They provide, and also Pacific Life, they have similar policies, All right, and okay, if this lady lives long and she will only qualify when she's 90 years old, so that benefit grow from 200K to 355, right? Yeah, so that's a nice increase adjusted for inflation, yeah. And right now, Nationwide Care Matters is even better, and they offer the 3% compounding and 5% compounding inflation riders. Yeah, so if you are interested to see the numbers, and you can ask whoever invited you to help you connect with one of our senior advisors, and they're able to show the numbers for your age and gender, right? And the whether it's a monthly pay for 5 years or annual pay for 5 years or 10 years or lifetime or lump sum, right? Yeah, you can see the numbers for you. And with inflation, without inflation, with 3% inflation, with 5% inflation, right? Yeah, it's a lot of choices for you, yeah, to cater to your needs, all right? So these are the two. And actually, myself, I have this type of policy too. I took one quite a few years ago, and when I was still in the 40s, in my 40s, right? And later on, and I saw my in-laws, they are getting into this situation right now. We're just experiencing. They're back in China, but we're seeing them losing ADLs one after another, right, over the last couple of years. Yeah, they are 89 years old and 87 years old, and luckily my husband got 3 other siblings in China. So they are taking turns, and also we hired nannies to take care of them. And right now it's just a lot of work and a lot of stress. Yeah, and make us thinking, we don't want that happen, to our children, and we want to make sure we have enough. So I have, I think if this long-term care thing happens to me, I have $1 million ready, so I want to go to the picture that Dan showed, right? That fancy like 5-star hotel type of facility. I want to live there. I don't have to worry about money, and my kids don't have to worry about money, and they can come to visit me, and bring me flowers and read me stories, right? And then I have everybody else to do the dirty laundries, right? Yeah. So, and also I want to stay in my home as long as possible. Yeah, that's why I want this the indemnity type, okay, not the reimbursement type. Okay, most of the reimbursement type, is tied to facilities, right, or professional care providers, And there's indemnity type. You can use however you want, right? At your home and or outside your home, or even, you know, later on if COVID is over and you can receive it on cruise, right? You know, yeah. All right. So this is a graphic a graphic demonstration of how this asset-linked long-term care works with your whole asset allocation. Okay, and so, you know, you have aggressive asset, you have moderate asset. I mean, this all refer to the risk, right? And also the return. Okay, so you have conservative asset. And when are you going to think about long-term care? Mostly, you know, is when you enter the 40s, and especially when you enter the 50s, right? That's when you experience your parents experience that, and you know your friends' parents experience that, you know. So you heard those stories, and then you think about yourself, right? Okay, so and by the time you are, you know, 50, and your asset will be like this. Okay, so the asset linked is just to carve out a piece of asset from your conservative holdings, right? Like that lady is from bank, right? Okay, and also maybe from your bond investment, right? You know, and carve a portion of that and just save it under the long-term care policy. And then it can give you what? A small death benefit and then a big long-term care benefit and tax-free, right? Yeah. Okay, the next case, okay. The next, I'm good, I need to speed up, okay? Yeah, next case, okay, is for the males, all right? I know the husbands, they like this one. Why? Yeah, because a lot of the men, I don't know, they think the long-term care won't happen to them. You know? Not my husband, huh? But you know, yeah, a lot of the husband think long-term care happens to their wife, maybe, mostly, right? So what they want is, hey, they don't want the bad consequence happen to the family, even though the probability is very small, but the consequence is so big. They don't want to burden their family, and they also want to leave something, right? Leave the legacy behind. And most of the time, if they are still in their 40s, in their 50s, and they have, they still have dependable kids, right? So they need the protection, okay? And they have limited resources. I mean, the cash flow or the savings, right? Yeah, so they choose this type. This type is the long-term care rider and plus the life insurance combo, all right? So this guy, and he applied for a $500,000 policy, all right? And add a long-term care rider on it, right? And you see how he's from a high-income family, married with 2 kids, you know, and wanting to pay the premium in 10 years, all right, and have the long-term care and the death benefit guaranteed, all right? So here's the solution for him, all right? Yeah, this is when he was 47, all right? He's paying a little over 1,000 per month and paying 10 years, 127, right? And then guaranteed either long-term care or death benefit, half meaning, all right? Everything's guaranteed, huh? Yeah, right now, you know, the guaranteed policy is not that many and becomes more expensive. Why? Because the guaranteed policy usually tied to the what? To the interest rate, right? The interest rate is coming down, and therefore, you know, the guaranteed premium is going up. All right, you know, luckily this was done a few years ago, you know, but we still got guaranteed policies if that's what you want, right? Of course, you can say, you know, you don't need the guarantee, right? Okay, and then you can pay less to get the same benefits. All right, yeah. So that's the life insurance and long-term care rider combo. All right, does one policy, you know, does 3 things: protection, right? Don't forget the death benefit, okay? The protection, right, at the early years when they still have the dependable kids at home, and also protect the spouse as well. Yeah, and the long-term care for himself. Yeah, long-term care for himself. Yeah, and also if he doesn't need the long-term care, he does not claim or he claim a little bit, then he still have this legacy passed over to the surviving family, right? So three functions with one policy. All right. The last example is a couple. Okay. Wow. This couple is a middle income. Yeah. And, they have multiple needs. Okay. The multiple needs is, hey, first, long-term care. Yes, obviously they're concerned about that. And both of them are concerned about their long-term care needs. What if I need care, right? And, where is the money, where is the money coming from to help me pay the care? Yeah, and so both of them realize they need long-term care. And also they say, hey, if I live long and I don't need long-term care, can I take income from this policy? Okay, so now they have another needs, right? The income needs, should they don't need the long-term care and they can take the cash value, to supplement their retirement, all right? And number three is, hey, if my other investment, my 401k, IRA, other stuff and grow well and, we're healthy and we don't need to withdraw the cash value or take long-term care benefits from this. And I like to leave this $500,000 behind to my children. Okay. Yeah. So this is their wants. All right. So the solution for this couple is also a life insurance with long-term care rider. Yeah. However, this is a joint life. Okay. With joint life, the death benefit is paid at the second death. Okay. What does that mean? That means lower cost of insurance, right? Yeah. Lower cost of insurance. Yeah. And with this type, they cannot protect each other. Okay, if the husband died, the wife would not get the $500,000. Okay, or the wife died, the husband would not get the $500,000, right? If both of them die, the kids will get the $500,000. All right, so it's a wealth transfer, right? Okay, yeah, and also with $500,000 long-term care and $500,000 the long-term care each, right, for wife and the husband. Okay, total death benefit is $1 million. Okay, let's see how it works, And the number may work a little different now, all right, because of the interest rate. Yeah, but you got the concept, all right? Yeah, this is $1 million death benefit paid at second death, and the couple choose to pay in 10 years. Of course, they can pay in 5 years or 6 years, right, or 12 years. Yeah, and this is if they pay in 10 years. Altogether, they paid $226,000, right? And the cash value, there is a cash value accumulation, right, within the policy, and they are protected with $1 million. All right, yeah. And when you look at the long-term care, okay, if the husband or the wife qualify long-term care, this is can separate. All right, when the husband qualify, the $10,000 per month will be paid to the husband. All right, and up to $500,000, right? And if the wife qualify, $10,000 per month will be paid to the wife, and up to $500,000. All right, and any remaining amount will be passed as death benefit, right? Okay, so and this is the long-term care. All right, and $1 million is death benefit if nothing got claimed, right? Nothing got withdrawn. Yeah, but the policy also build the cash value. You can see here, this is the cash value. Okay, yeah, and then they can access this cash value, right? Also to supplement retirement, all right? In case, if they don't need long-term care, all right? Yeah, even if they claim some long-term care, if they need the cash, right? They need more than 10,000 a month, and they can still make some withdrawals, yeah. So this is the fourth case, I like to share with you. I think with that, I want to wrap up the case study, and I know we got some questions in the chat box, and let's see if we can get to them. Yeah.
All right. Thank you, Jenny. Thank you, Jenny, for that in-depth coverage of the case study. All right, Brandon. Brandon had sent over a couple questions.
Oh, okay.
Yeah. So first question is, has insurance? Sorry, give me 1 second. Let me pull this up a little bit. Has insurance company figured out how to provide known premiums year to year for this? So
Has insurance figured out? You mean where is that? The first question, figured out how to provide loan premiums year to year for this?
yes.
Okay. With the with the type of policies that the case studies that I provided, the premiums are fixed. Okay, right? Especially with the asset linked benefit. Okay, yeah, and the benefit also is fixed with the asset linked benefit. All right, this is not the standalone one. Okay, yeah, and with the life insurance and the long-term care rider combo one, it depends whether you have added a guaranteed rider or not. Yeah, if you add a guaranteed rider, then your premium and your benefit also can be fixed. Yeah, if you did not include that rider, and then your benefit, you can fix the premium, and then your benefit will fluctuate, right? But the long-term care is always going to be there. If you bought a $500,000, as long as you have the policy, right, that long-term care will be there, but your cash value will be, fluctuate. Yeah. I don't know if I understand Brandon's question. Yeah. If not, please unmute yourself, and we can talk more. Yeah.
Brandon, are you still on?
Yes, I'm on. I think that addressed the question.
Okay.
Basically, the writers have a steady fee to provide their benefit.
Yes.
That's a great takeaway. The other question I had was, in your example, you said that somebody who makes a health claim to start utilizing part of that benefit period, they need to recertify each year.
Yes.
I come out of the healthcare profession, and I've seen, especially in long-term care, people start with home health because their health is generally good, and they decline over time.
Right.
And let's say that somebody fell, had a hip surgery, needed rehab, goes home with home health. They would probably start a claim at some point with that incident. Then let's say that, under your scenario, they're able to claim it for a year. At the end of the year, the doctor says, hey, you know what? I think you've recovered. Okay. And then that ends that benefit claim period. The annuity is still going on, I suspect. And let's say 2 years later, that hip replacement has caused some kind of other issue, and now there's a blood clotting issue, and now they go into assisted living because they've lost some function.
Right.
Would they be able to make another healthcare claim on that same annuity rider to start what would be, I guess, year 2 of the benefit period?
Oh, very good question. Yes, Brandon. Yeah. Wow. I'm glad you are on. Yeah. The terminology you're using, it's very professional. Yeah. You come from medical field. Great to have you on, and yeah, great question. The lady picked 6 years.
6 years.
6 years, right? And your example is she used 1 year. All right.
Yeah.
So she has 5 more years left.
Okay.
She can claim in any time in her life. Okay, the remaining 5 years, And
Okay.
as long as she claimed later, because she picked the inflation rider, so she's going to get paid a little more, right? Yeah.
Mm. And when you add a rider to an annuity, is it an entirely different feature from the annuity, or does it affect it in any other way?
All right. Yeah, the example I'm giving is all the rider is add to a life insurance policy, not annuity.
Oh,
Yeah.
okay.
Yeah, so it requires underwriting. Okay.
Oh,
Annuity does not require underwriting. And when the rider is added to a life insurance, it's paid. The benefit is paid tax-free. Okay. Yeah,
I
that's
see.
why usually, it's added. If you qualify, you can qualify, added to a life policy is a lot better. Yeah.
I see. But if they add it to an annuity, do the original features of the annuity stay the same, like the cash drawdown, as they start to take the benefit?
If the rider add on to like a regular life policy, and the general features of the life insurance stay the same.
Okay. So the drawdown amount, because of the rider, doesn't affect the overall, I guess, value of the annuity.
It
right?
will affect the cash value, but it will not affect the features. The features,
Oh,
is okay. He still has the cash value. Okay, but if he takes out, say, 10,000 for the long-term care, and then that 10,000 will be deducted from the cash value. So
I see.
Yeah. Mhm.
So basically, if I had an annuity, and let's say it was $1 million, and I wanted to draw down, normally 100,000, I mean, a ridiculous example, but 100,000 a year.
Mhm.
And then I had this health rider on there,
Mhm.
and suddenly that triples the benefit, right? So instead of drawing down 100,000 a year, suddenly I'm getting 300,000 a year.
Right.
What I understand is that that would draw down the cash value of my annuity 3 times faster, but still leave in place the contractual obligation for the annuity to pay out for the length of my natural life. Is that right?
Okay, now you are talking about the annuities. Okay.
Yeah.
The annuities works a little bit differently from the life insurance. Okay, the annuity, if according to what I heard, I think you have an income rider on that annuity that promise to pay you income for life.
Right. Yes.
Yeah, and now with a long-term care rider, maybe it's a built-in with annuity, right? Now all of a sudden you qualify, and they will pay you twice, okay, income, right?
Right.
As regular, right? So you see your accumulation value of your annuity got reduced more quickly, right?
Yes.
Yeah.
That's what I
Okay.
was at.
That's
Okay.
correct. And usually most of annuity, and once that the cash value drops to 0, they would not pay you double. Okay.
Oh,
They
okay.
would
That's good to
revert
know.
back to the regular income. Yeah, you're still going to receive the regular income.
Okay. I mean, I'm asking a lot about annuities because
Yeah.
my father is, in his 70s, and I suspect that, they probably won't give him a life insurance policy, at this ripe age.
Right.
So, but annuities are more in the realm of possibility.
Right.
So,
Right.
I wanted to understand, especially
And-
the long-term care rider.
Sure, yeah. And Brandon, understand that each annuity is structured differently. Yeah,
Yes.
so to be sure, what's built in to your father's annuity, and I recommend you to just ask, I don't know who invited you here, and, he can connect you with a senior advisor.
Okay.
Yeah, and we'll be happy to look at the statement and then to analyze the benefits, for you. Yeah.
Is it generally more efficient then to use policies this way? I guess that guarantee a fixed amount?
There is a age and health situation involved.
I see.
Yeah, and also the affordability of the family and what they want, right? They want death benefit, they want long-term care, they want both, or
Sure.
they want liquidity, right? Yeah. So there's a lot of things, and what we can do is number one, we work with more than 100 companies. Okay, so we have all different tools, right, to help provide solutions to a specific family and to the specific needs. That's our strength. It's not like a one size fits all. You have to look at your situation and analyze and look at your, what you want, what's your priority, and where is your resource, your income or your savings, right? Yeah, and how is your health situation? And then, we'll do analysis and make recommendations for you. And if you have existing policies already there, and we'll be happy to review that and make sure you max out the benefits you already have. Yeah.
Okay, thank you.
Yeah, sure.
Thank you, Brandon. And we have one more question in the chat room, Jenny, if we still have time. I'm not sure. It's WPL asked the questions. Is any product
Anything without the elimination period? Oh, very good question. Yes. Okay, most of the policies got a 90-day, 100-day, 120-day elimination, right? But some policies, they don't have the elimination. So you just ask whoever invited you, okay, and they can show you those options. Yeah. Mhm.
All right, thank you, Jenny. We're running a little bit over, but anybody else has any more questions while we have Jenny here on the panel?
Yeah, thanks everyone for the great question. Yeah, Brandon, thank you for your question. Yeah, those questions, when we discuss questions and people here, they also learned. Yeah, they appreciate the question and which can make the information, more relevant and, yeah.
Yeah, we love the interaction and participation from our guests. With that said, again, I want to thank everyone for taking the time out tonight to join us in our open seminar. A reminder, if you do have any particular questions, feel free to follow up with the person who invited you, and we would love to have a sit down and look at your particular situation to provide more advice. With that said, everybody enjoy your weekend and have a wonderful night.
Thank you, Fu. Thank you, Jenny.
Thank you, Fu. Thank you, Dan.
Bye.
Yeah, thank you for your presentation. That's
Thank you.
great. Wonderful. Yeah.